Michael Burry isn't the only investor that profited handsomely during the great financial crisis. There was also Steve Eisman running FrontPoint Partners during the time and supposedly made around $1 billion. Their story was profiled in Michael Lewis's book, The Big Short, which you can see over my shoulder. And they both are currently making calls on warning investors on where they think the market can go in the years ahead. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. So let's dive in to understand, well, what is Michael Burry saying? What is Steve Eisman saying? Both who profited handsomely, once again, from the great financial crisis. For those that aren't familiar, Steve Eisman was played by Steve Carell in The Big Short, the movie. And it was a different character's name. They called him Mark Baum, but that was supposed to be Steve Eisman's character. And Michael Burry was supposed to be Christian Bale during that story. In The Big Short. So recently, what did Michael Burry have to say? He said this time is different. He showed a chart mapping the S&P 500, that's the yellow line, going down over time, along with the Fed funds rate, which was also going down. This was during the following of the dot-com implosion, saying really the key lesson that Michael Burry was saying is everyone's hope that you might have the Fed lower rates later this year in 2023. In response to some weak economic conditions. He's trying to say that won't help you. Just look at what happened in after the dot-com implosion. The Fed funds rate dropped significantly, and you still had a collapse in the S&P 500. So he's trying to say this time is different. It's arguably even worse because now the Fed is also still raising rates. So this is, yes, you have a different economy, and it's arguably much better, I'd argue. But I think this is the argument he's making, which is that last time the Fed was lowering rates to deal with the upcoming trouble that they had with their recession. And the stock market still declined. And he's effectively saying this condition is actually worse that you'll see possibly in the year ahead. We'll see. That's what Michael Burry is warning investors about. Now, what's Steve Eisman have to say? So he was interviewed with a Bloomberg podcast called Odd Lots, which I enjoy. And he was saying, that's a picture of Steve Eisman, if you're not familiar with him. He was saying that we're facing a new paradigm. So what does that even mean? How should investors think about it? He broke it down into a couple of components. The first component was a lot of the stocks that are rallying right now, he sort of described it as like a last hurrah. Like he's like a lot of these like unprofitable growth stocks, unprofitable tech stocks that a lot of folks are very excited about, like Open Doors or Carvana, that went up crazy amounts year to date. He's like, this is like a last gasp, like last hurrah, where everyone's thinking that the Fed will somehow come to their savior. And it still doesn't make sense. These were the things that were hot in the last cycle. And that's a really important point to consider when you think about a new paradigm, because what he's saying is when you're looking at a new market cycle, you oftentimes have new leaders, and you're going to have different cycles. And this is so important to look at across many different cycles. So what recently worked in the frenzy of 2020, responding to the massive stimulus you saw in 2020, is probably not what's going to be the next leaders of the market. And you go back over time, in the late 90s, what was it? Well, it was the dot-com stocks that everyone was like to the moon. The AOL, Time Warner, the Amazons. After that implosion, and you had a whole like web van on a whole bunch of things that went to zero. So then after the dot-com implosion, you had what became the next leaders. Well, it wasn't Amazon that was everyone's favorite at that time. That wasn't the leader that everyone was focusing on. The leader during that time actually became the housing stocks and the financial institutions. Those became the leaders, and those were the ones that subsequently blew up. So then you look at the next market cycle. Okay, now it's the FANG stocks, the Facebooks, Amazon, Apple, Netflix, and Google. And these have all gotten severely beaten up. And arguably, the competitive dynamic and the returns ahead will likely be much lower for these companies than they've been during that last really strong market. So he's making this point like, look, we are in a new paradigm with higher interest rates, probably higher for longer, as the Federal Reserve is saying. You're probably going to have a different economic environment. where investors are going to want to see real free cash flow from their businesses. They're going to be judging businesses based on what's effectively that free cash flow they can return to shareholders. That is so important to think about. And that's how arguably some of the best investors have made their mark, have made their career. The Warren Buffetts of the world, he didn't really make a lot of money from betting on unprofitable companies. Sure, that there were those occasional ones, but by and large, it was looking at companies that had already proven themselves, and he was wondering, okay, what will they compound out in the years ahead, 10, 20%? Could he get a reasonable cash yield year in, year out from owning that business? So the winners from the last few years, the ones that got a lot of folks excited, yeah, you need to be looking at what's going to drive the future going forward. And whatever drives the stock price, it always comes down to three variables. It's the fundamentals of the business, it's the valuation, and it's the cash flow that can be returned to you as investors. So you should always think, okay, well, is the valuation compelling now? Are the fundamentals compelling now? And he's arguing, this is Steve Eisman, in a similar camp to Michael Burry. He's not as severe as Michael Burry, I'd say, but he's making a similar point to saying, hey, this is what worked in the past isn't necessarily what's going to work now. You need to look at a new market, a new leaders. Another key aspect that he called out, as interest rates and mortgage rates move higher, you'd expect to see, and he called out somewhere between a 30 to 40% drop in home prices, just because the difference between a 3% mortgage and a 7% mortgage, does translate into, if people can only afford so much with a 3% mortgage, you'd have to have this huge drop in home prices. But you haven't seen that, really. You've seen a little, but not a lot. You haven't seen that 40% drop, which would be devastating. It would be really bad. Well, he makes a point there. This is Steve Eisman. He's making the point that the reason why you haven't seen that, at least so far, is because the market is sort of frozen and because the employment picture is still very tight. But if you were to have a situation where unemployment starts rising and people can no longer even pay for their mortgages, then you could actually start getting liquidity back in the market because people become forced sellers. And then in that point, when they become, if you have the unemployment start ticking up and you have people that can't cover their mortgages, then you have that unfortunate situation where home prices really do start falling. But as long as unemployment remains quite low, people will still be able to pay for their existing mortgages, and they're just, the market liquidity is dropping significantly. So it's a much less liquid market because the rates have moved higher. So that's a really interesting data point that does suggest, like, hey, this is a bit of a fragile situation. If the economy starts to worsen, you really could have a secondary punch to the face when you could see, home prices start dropping precipitously as well. And that would be, it could have huge secondary effects in terms of the market, in terms of the economy. You could create sort of fulfilling problems there. Now, will this be another great financial crisis like 2008? He personally thinks it's actually probably not. Probably just another run-of-the-mill recession. That's what he framed it as. Partly because the structures and the limitations, the fragility that we had in the economy back then, with several banks that were levered 40-1, where all it took is a little bit of a decline in their assets and they're then insolvent, or they underwrote things that then blew up like AIG. Well, you don't have that type of leverage on the corporate balance sheet with the mega banks. What you have now really is the leverage with governments. And so far, you're not really seeing that risk with where government bond prices are, but that is a potential risk that I personally think that investors should be mindful of, particularly, like when you look at the situation that's going on in Japan. I'll make a whole separate other video about that if you're interested. And so the question is, well, how should you sort of play this? You're looking at an environment where Michael Burry's saying things can go lower. You're talking about, where the Fed isn't helping you. You see Steve Eisman talking about this, a new paradigm that investors should be prepared for, one with higher interest rates that will impact valuation and earnings. What should you potentially think about this? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. So let me share my thoughts on how I'm thinking about this new paradigm, because I'm 100% on the same page that this is a new paradigm. And I've called this out to my subscribers like a whole new world. I've been saying this for at least the last year. Being in a period where the Federal Reserve doesn't have your back by raising rates, that is very, very different, because they're not in a position where they can lower rates because inflation is too hot. We have not been in this position for decades. And not having that Fed put means potentially much lower valuations. Also, having higher interest rates means that the appeal of owning an unprofitable tech stock is not there when you can get 4% plus at Interactive, for example. And I link below for, if you want to get, that 4% plus with your cash balance at Interactive Brokers. So there's a link for Interactive below. And so I look at this and I'm thinking this is a different environment. When people can get a real yield on their cash, there's, millionaires out there, they're getting their $40,000 just sitting in cash, $10 million. If you're sitting on $10 million, you're collecting your 400,000, and they're saying to themselves, hey, why do I need to take risks on these speculative things when I got this 400,000 and I can, redeploy that? I can sit on that. And when I find that there's an incredible opportunity, then I'm going to deploy it. But until then, forget it. Wait for better opportunities. So I think that's really one of the first lessons, is be really much more disciplined. And I think that's what you've seen with the marketplace, where a lot of these unprofitable tech stocks, a lot of folks are saying, wait a second, I don't actually want to own this garbage. Like, I'm going to be more disciplined. So I think we are in the first part of adjusting to this new paradigm of, hey, I want to be disciplined about owning businesses that have real free cash flow that can go to me. And it's not just sort of a funny money business that can just, has a high, maybe it has significant free cash flow from stock-based compensation, some sort of nonsense like that, where it's just creating additional dilution. So that's a first really important point. Be really disciplined about the price you want to pay. I think the second really key aspect is to consider businesses that are very, very stable in nature. If you have this wide range of possibilities, including a 40% drop in housing, which could be very, very problematic. We haven't seen that yet, but that is a possibility. And with investing, oftentimes you're working, you're sort of operating in a cloud. You don't really know exactly, what it's murky. You sort of, like, will housing do this? You have to think about a range of different possibilities. And so I think in this environment, looking for the businesses that have proven themselves as compounders is very valuable. Looking for the stable businesses with 80, 90% recurring revenue, that's personally what I want to see. And personally, what I'm buying and calling out to my subscribers at Unrivaled Investing is I'm looking for those businesses where I go, even if this is a tumultuous period, I'm going to want to own those things that I think, hey, they can keep compounding, they can keep growing. That's what I want to see. And then I think the last key component is you want to pay a reasonable valuation. And for those things that, let's say, you think can compound at 5, 10, 15% growth per year, you want to make sure you're paying a reasonable multiple of real free cash flow. For me personally, I'm thinking anywhere from, let's say, 15 to 20 times would be like, that 20 is sort of my absolute max, maybe a little bit more if management says, hey, we think we can grow 15, 20%, per year. So when I look at this, I'm thinking 15 to 20 times, because 20 times is the equivalent of a 5% yield for shareholders plus that growth, 15 times closer to 7%. And so that's how I'm looking at this market, is I want to at least get that 5 to 7% plus, which is a premium on top of the 4% I'm getting from my, cash at Interactive Broker. So I should get some sort of premium plus the growth that I'm expecting from the businesses, which, by the way, it's never certain, because you're in that environment where, Michael Burry saying, as he always thinks, like, hey, this is not the same. This is different. It's worse. And then you have, guys like Steve Eisman that are a little bit more moderate, but still says, hey, this is a new paradigm. Beware, folks. This is a warning for investors that this will be tougher. So I think this is really important for you to consider. Like, I have called out on this channel Amazon as an example of a company that I think is great. And I called it out at $82 a share, a few weeks ago, where I said, hey, I do think this is close to deep value at $82 a share. So I think that is an example of where you want to make sure all these pieces fit. Okay, so super stable business at $82 a share, you could start saying, okay, the valuation is very, very reasonable, even if they're not generating the cash flow that I want to see. Could they be? Could sort of pencil out a very reasonable valuation? And are you being disciplined about, like, okay, I'm going to wait for the price to be compelling before I just go, okay, I'm just going to buy it. I'm just going and chase a lot of things. You've seen a lot of investors just chase things that have a lot of just garbage. And Steve Eisman's, pretty much calling that out, that people were bidding things up recently, so far year to date in 2023, on the anticipation that, hey, maybe the Fed's going to ease up sooner than expected. I personally, once again, I'm in the thesis of this is a new paradigm. It's appropriate to invest accordingly because the leaders of this cycle will likely be quite different from the leaders of the past. If this video about Michael Burry and Steve Eisman's warnings have been helpful for you, please make a point of hitting that subscribe button. Thanks so much for watching Unrivaled Investing.